Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video in which we will be talking about the US dollar. Specifically, when does the dollar revert to its standard safe haven appeal? Alright, this is a very important aspect of the greenback's performance and one of the key fundamental catalysts. But then why did we not have a significant rally from this benchmark this past session? There are a number of reasons why, and we need to understand them fully if we want to be able to project where the US dollar is going to go and with what intensity. Now, most of us were watching, even if you're just an FX trader, the performance that we had in the US equity markets. All right, this is essentially the 2013, that goes back to November, rising trend channel, fits nicely within this much larger rising channel that began back when we bottomed out in the first quarter of 2009. And as you can see when we zoom in, we finally broke that floor. All right. Now, for those that follow me, know that this is one of my preferred measures of sentiment. All right. This is not only a reflection of risk appetite trends, but furthermore, it is a reflection of the confidence that is derived from stimulus. I'm not saying stimulus is a particular trading opportunity because it provides some abnormal levels of return. I'm just pointing out that it does lower volatility, lower the assumption of fear, and lower the assumption of personal risk, encouraging people to take additional exposure themselves. So the breakdown that we have from this S&P 500 is of particular interest. All right, this speaks to me and says this is a serious risk aversion. Well, we would see some level of confirmation of that risk aversion in the market's preferred volatility index, the VIX index, also called the fear index. If you're not familiar, I suggest that you do acclimate yourself to this measure. And we did have a jump above 20% this past session, so fear is rising. The U.S. equity markets have made a significant technical break to the downside. So what was the U.S. dollar? Was it playing its role as a safe haven? It was not. The U.S. dollar index, as you see here, actually stabilized and continued with this congestion. Just slightly above this important technical floor, but not making any progress one way or the other. In fact, it still has that bearish momentum behind it, threatening a much more substantial break to the downside. All right. Why is there a dissociation between these two benchmark assets? This being an ultimate safe haven and this being a key measure of risk taking. All right. Well, this is actually a relationship that we have seen, positive, unusual relationship, is one we've seen for a little while now. It does not necessarily strike us as too remarkable that there is something of a positive correlation here. You can see that this has been an issue since around a year, actually 13 or 14 months. But the implications here is that, one, we don't necessarily have a clean risk, clear, strong, fundamental drive for investors to deleverage. This is actually a measure of realized volatility. All right. So when I show you the VIX, you have to understand that that is expectations of volatility, backed out of options. All right, this is realized. This is the actual volatility over the look-back period that we have. I use 3 months or 60 trading days as a good medium-term gauge. Well, we are still below 10%, which is extraordinarily low. And we've been below that benchmark or that threshold since essentially 3 weeks, 4 weeks now. This is the longest period of time that we've been this quiet since back in the beginning of 2007, as you see at the beginning of that graph. All right. So one of the concerns is that we are not actually seeing a full-scale risk aversion move. All right. But we do have quite a bit of room that we can close between standards of risk, benchmarks for risk, like my risk-reward index, and the S&P 500. So one thing that we can look for is seeing the scales of risk truly intensify. All right. If we really get a acceleration to the downside in the S&P 500. It will do much more to awaken the US dollar's role as a safe haven currency, really leverage up its appeal as investors move away from riskier assets, whether they be fundamentally overvalued like the pound because of its interest rate expectations. Seeing a break below 160, that would be a great trade. Or the Euro USD, ignoring clear fundamental uncertainties in the Eurozone periphery, for example, and seeing that pullback. Or even high-yield currencies like the Australian dollar versus the US dollar, seeing an unwinding of that carry trade. Lots of potential with that theme, but you must see a full-scale risk move. Now, one of the big reasons that we do not see this move translate into a move like this, upside for the US dollar with some level of conviction, is that there is a transmission gap of this risk. A good sign that you don't have full commitment, full-scale risk aversion in the market just yet. And a good measure of this is the relationship between the volatility index, or the fear index for the equities market, that you see here in the blue, the VIX, and the FX version of volatility, which you see here in red. You can see quite clearly that there is a substantial divergence in their performance. In fact, there was another big substantial divergence in this peak here. Guess what was happening around this time? This was the turn of the year. This was when we were heading into that budget standoff at the beginning of the year into the beginning of January. All right. As you can see, it did lead to a modest pickup in FX volatility, but it was much more prominent in equities. Inevitably, it was equities that saw that rapid cool down. All right. This is a similar looking situation, but this can certainly escalate to new heights if we do see a much more substantial follow through in the deleveraging effort. Now, when you're comparing the US dollar as a safe haven, all right, you don't want to do it to the VIX. You want to do it to the FX volatility index. As you can see here, the correlation between the two is substantially better than if you tried to measure up the standard VIX to the US dollar. All right, so you do have the fundamental theme there, in other words, but you do not have the scale. All right, we need actual full-scale risk aversion, not just isolated to U.S. equities because of the situation that's going on there. We need it across board, across assets. And then the U.S. dollar can start to really pick up. One of the reasons that we don't just simply hover higher on the U.S. dollar, given this situation, is because that there is a countervailing wind. We have the U.S. budget situation. All right. Now, I told you just the other day, actually, that as the situation deteriorates, as the crisis in the United States, if it does lead into a deficit ceiling breach, you can see more about that in yesterday's Forex strategy video, in which I covered the deficit crisis. This is a possibility that if we extend that, exacerbate that risk, that the U.S. dollar will actually turn into a safe haven. So it will rally as credit concerns in the United States actually deteriorate. So that's an extreme, right? But at this point, we're not at that full-scale extreme. We are not seeing that full-scale risk aversion, all right? You need a heavier risk aversion theme to offset the concerns that there are in the U.S. assets as this credit default or essentially just budget stalls and economic impact that is currently having on these financial markets. Investors are just concerned about U.S. assets. All right, so they are looking for reasonable alternatives. European, Asian-based, even North and South American alternatives. But as we get to that fuller scale risk aversion theme, as it really starts to escalate, and even the S&P 500 is a really good measure of this. So as you see this pullback, and if it does accelerate its move to the downside and start jumping to different asset classes, that's when you see that reasonable alternatives simply do not meet the requirement. People need ultimate liquidity, and they are willing to overlook the fact that it is once again a U.S.-sourced crisis because they need liquidity, no questions asked. All right. So as I said, there are a lot of options for this kind of theme. Aussie dollar, euro dollar, pound dollar. I like the pound dollar a lot, actually, for its fundamental bearings. Even the dollar yen, although this is a little bit more complicated given the conditions we're speaking about. There's a lot of options, but if you want to trade the US dollar, you absolutely need to understand its relationship to risk and when it is treated as an ultimate safe haven and sees that demand, or when you see risk trends improve and it actually starts to fall apart. Once you understand that concept, the scale on the risk theme, you'll much better understand how to trade the dollar based on fundamentals. Okay, so keep an eye on the dollar, keep an eye on risk trends. Those are two key factors this week and will continue to be going forward. We'll do another Forex strategy video tomorrow. Until then, good luck trading out there, and I'll talk to you guys later.